The third investment I ever made was $1,000 worth of AGF growth fund. I just read The Wealthy Barber, which is a classic of Canadian finance, and it had talked about investing your money in mutual funds for the long term. This was before the real big breakout of ETFs. I hadn't yet read Malkiel's Random Walk Down Wall Street. The fund had a management expense ratio, I think, of around 3%, which I didn't pay attention to at the time. And I had looked at its past performance, which was fantastic. I obviously didn't pay attention to the disclaimer that past performance is no guarantee of future results. And when did I buy this? Well, this was May 7th, 1999. In less than a year, the market was going to peak and the dot-com bubble would burst. This was not going to end well. Today's guest is a former proprietary trader, which means he used the bank's money and traded in and out of different products in order to make a profit for the bank. A lot of times they're closing those positions at the end of the day, or at the very least, they're marking those positions to market at the end of the day. So they're looking to see if they've made a profit or a loss over 1 day period. This is a little different, obviously, than being a retail investor or investing for very long-term gains if you're looking for your retirement account. But he has a lot of interesting insights. He also worked as a market maker in foreign exchange, which means he had to be ready to provide liquidity to people, like buying or selling large amounts of foreign currencies at any given time. After a long career in the UK, he now runs Suberia Capital in Brisbane, Australia. Hi, we're here with Ian Reynolds of Suberia Capital. Ian, you started, I guess, with a degree in physics. Was finance the original plan?
No, physics was the original plan, but that didn't work out. And that changed really because as I grew up, Margaret Thatcher, who was the Prime Minister of England, deregulated the London markets, which was full of old people in top hats and stuff. And it brought in a wave of American money. And we lived through great prosperity from that for, to this day to some extent, but certainly there was a 15 to 20 year wave of everyone won.
Well, and I remember at that time, that's Canary Wharf is just getting going.
Yeah, so Canary Wharf had been built and we had a duplicate dealing room there where if something bad happened, we went to and carry on trading. This is well before the internet, so all the banks were hardwired by Thomson Reuters. So an intranet or an extranet, depending on how you want to view it, which was really interesting because without any internet, everyone else had no idea what we were doing.
And did you start with Scotiabank? Is that right?
I started originally with a bank called Manufacturers Hanover, who is an American, or was an American bank, and it got absorbed into Chase 30 years ago, 40 years ago or something. So just a bond house. So that's where I learnt some stuff. I left to go to Bank of Nova Scotia because they had a graduate training program, which seemed a lot more suited to my inexperience, and just really liked the place. Rather than being American, it was Canadian, which was very laid back, as you know.
Well, yeah, I think I'm actually a shareholder in my wife's account. So then you went all over the place. Looks like you're in Kuwait maybe, and Zurich. Is that right?
No, I wasn't in Kuwait. I did join Bank of America in Zurich, where I went for a year and a half. I also traded my own money on the London International Financial Futures floor, i.e. similar to the Chicago Board of Trade, but just for financial futures. And then I was a proprietary trader at Kuwaiti Bank in the end.
And so you're using their money.
Well, not on the life floor. I was using my own money there.
Okay. And then Kuwait, you're using their stuff. Okay.
Yeah.
Oh, that's fascinating. So, and then what brought you down to Brisbane?
I thought I retired, should I say, more specifically, in about 1998. My wife, she's from Brisbane, hence the connection. And we came over here. We went around the world for a few years, ended up here in 2001. And then since had 6 Australian children, so I've had to unretire myself to some extent.
You have 6 kids?
Yeah, I do.
Well, that's one other thing we have in common. I thought I was the only crazy one.
That's why we're still working.
Yeah, that's right. No retirement in sight. I know what that's all about. So were you retired during the first dot-com bubble there? Did you dodge that bullet?
I was effectively traveling around the world, but I mean, I've been investing my own money since I left London.
Okay.
Trading it and investing it. And when I got to Australia, I started investing in tech companies. Bitcoin turned up, so early investor in Bitcoin. And yeah, so it's always been about financial markets. I've never really been retired, only technically from not having a wage, I suppose.
Yeah. Okay, so the questions I usually ask all my guests then is, what was your first investment?
Well, I didn't have any investments till I joined the bank. And my first investment was, crazily enough, a house in London, because at that time, mortgage rates were, I believe, 24%.
So what year we're talking? The
Late 80s, it would be. No, it must have been 92 or something like that.
Oh yeah, okay.
Yeah.
Like that's pretty much the peak, right?
Yep, that's right. But luckily, the Bank of Nova Scotia gave me a mortgage at 5%. So,
Because you're an employee, you got it 5%?
yeah. So
Wow.
that was a good first investment for me, because
Yeah.
obviously it got me in cheap.
Yeah, okay. Well, and I'm sure, I mean, you don't still own the house in London, do you?
No, I sold that many years ago.
Yeah, okay. So you were doing prop desks. What's your worst investment? I'm sure you must have had some bad days there.
Well, half of the time in my career, I was a market maker, which is a different thing from an investor. But, as a prop trader, you're only allowed to invest in certain things, listed markets, ones that are approved. So, every other day you're making losses. I've lost $1 million on a trade. I've made 5 million on a trade. So luckily, that's the right way around. It depends how many bad trades you have per good trade, doesn't it?
And was a lot of that foreign exchange? It looks like you did lots of different things.
Yeah, predominantly bond or interest rate futures, because those were the super liquid entities and you could get your orders down into the pit really easily. And you got a lot of feedback flow from open outcry pits, where your brokers down on the floor, they can see all the volume coming in, the buy orders, the sell orders, they can see it coming in. So if you have to get out, you can get out early, or you can get in better, obviously.
Now, that's a lot different from today. How is that? I don't know. How does that affect your ability to make money in those kind of markets?
I think if you're leaving yourself to the whims of exchanges, it's far more difficult these days, especially smaller exchanges, not in terms of the exchange itself, by what it's quoting. You're okay if it's the NASDAQ, but if you're a smaller stock market, then what liquidity do you have? I mean, as a retail trader, you don't necessarily have to care that, but as a professional trader, you do. Also, the real price is never what's on the screen by definition. And as foreign exchange traders, that was absolutely the case. If you saw my price, I guarantee I wouldn't quote you that. Everyone else is looking at it, right?
Yeah. So for yourself personally, what's your worst investment for your own money?
I've invested money in crypto projects that haven't worked. None have actually been scams or rug pulls, I must say. They're just the ones that, when you invest in altcoins, for example, and Bitcoin's not running, even if Bitcoin's stable, the price is going down every day. And there's no rhyme or reason. It's a long only market, and there's no one going to take you out. So your timing has got to be immaculate. But it's kind of one of those things where, if you lose 10 grand a day for 2 weeks, you can make 200 grand when it does go up. And it's really, like all trading, it's all the discipline of how you manage your position, what size it is, how you get out of it, how you get into it, all that sort of stuff.
And you would characterize yourself mainly as a trader, right? That's like, as opposed to, say, an investor.
Yeah, we definitely, as a family, we have our money in investment type products like gold, silver, things like that, where I normally put that in my wife's account so I can't fiddle with it. We just have a meeting every so often and say, what as a family do we need to achieve? Let's put on those positions. And Kim, that's my wife, she runs it. And only when she needs help does she ask me, because I will be continually fiddling with it, trying to be clever with it. Whereas really, from the investment perspective, you've got to look at a 5 to 10 year timeline on it.
Now, in Australia, I'm not familiar. Do they have like a tax deferred savings account for your kids' education? Do they have that kind of setup?
No, they don't. I think the best thing we have over here is a superannuation scheme, which is like your 401k.
Yeah.
And the employer puts money in and it's got tax benefits. It's not tax-free, but it's got tax benefits, and you can run it yourself. You don't have to let somebody else run it.
Okay. What then would you say is your best investment ever? Like for your own, or best trade, you can tell us, I guess, but for your own account.
So I've been super good at Bitcoin. I've hit pretty much every high and low since 2016, which is when I first got in.
So you first bought it 2016. What were we talking about then?
Now that was the year, and the price was sub $1,000. I've been in it. I'm an OG in the Bitcoin space.
Yeah,
I've been in there for nearly 10 years.
What got you into Bitcoin?
Initially, I was working in a co-working space because I could, to meet people rather than sitting in an office looking at screens.
Are you in London at the time?
I was in Australia.
You're already here. Okay.
Yeah. And I was sitting next to some kids who were looking at a screen, and I said, "That looks like trading markets." And they went, "Yeah, it's cryptocurrencies." And obviously I said, "Well, what's that?" So they explained it to me, and I went, "Okay, well, why don't you buy here and sell here?" And they went, "Wow, you know what you're doing, don't you?" And I said, "Well, it's in front of you, isn't it?" And they said, "No, we don't understand anything that's in front of us. We're just trying to do it because we got a bit of spare cash and we thought we would." And so, I helped quite a few people understand the more technical things about Bitcoin, i.e. the monetary supply of it, and how being subject to blow off tops and, buying it as it goes down, there's a certain maths in how you accumulate the position, knowing that at some stage it's going to go up and it's going to go up a lot, and how you scale out and not have to wait for the exact high, or because you won't, because it'll happen when you're not there and it'll be completely bonkers, which it has been pretty much. So just some techniques that help you get into those really big range markets.
So for your Bitcoin, you're not part of the hold till you die kind of crowd. You've been trading in and out along the way.
I have a trading position and I have an investment position. Yeah. So the investment position I put in my superannuation fund, self-managed superannuation fund, and the idea is to borrow against it in due course rather than sell it.
So can you hold Bitcoin in your superannuation funds directly in Australia?
Yeah.
Oh, okay. And when did that come about? Has that always been?
Well, I would say in the last 3 years, superannuation fund was created in, I think it's 2000 or something. So it's quite a new thing in itself. And as soon as the ATO knows how to tax it, you can trade it or invest in it.
Yeah. Oh, okay. All right. Now, are you interested in it? Because I've seen you've had a couple other podcast appearances where you're talking about Bitcoin. Are you interested in it solely as like a commodity or anything else that I can trade and make money on it? Or are you kind of a true believer here in that it's the future of currency? Or
I think it depends what day of the week you catch me on. I can quite see how people become Bitcoin maxis if you're technical, and I've founded a number of tech companies, so I kind of have an idea around the technology. I can see how you really get into its really nice, simple way of doing things, and so far has been unbreakable. I can see why people thoroughly get into that. Does it change lives? Well, it has changed lives. Is it the future of everything in the world? Probably not. Is it the future of money? Who knows? Could be. Currently, it's the best alternative to what we have, I think.
You were around for the breakdown of the Louvre agreement, and so you were right in the middle of all the currency stuff. And during the formation of the euro too, right?
Yep.
So you've kind of seen some of this play out before. Is there similarities there, or are you just, is it all about the technology?
If you look at when the euro formed and Italy joined the euro, particularly the eurozone, you saw that, I can't remember the exact rates, but let's say German rates were 2% and Italy's rates were 4%. As these two countries merge into one framework, then it's only going to be one rate. What is it going to be? 2%, 4%, 3%? Who knows? But you can tell that these two things are converging on a point in time, and they have to. This was the biggest trade in most people's lives. I think it was Salomon Brothers, who was the biggest bond house in the world ever, had 3/4 of their balance sheet with this one trade because it had to happen. And if that's one sort of niche of a huge structural move financially, then Bitcoin is the same thing in a similar way, but it's not quite so clear. We don't know quite what those parameters are, but traditional finance is going to merge into decentralized finance. And so the bets are all on the biggest brand in decentralized finance, which is Bitcoin. And now Ethereum obviously is getting a leg up. But the future, 5-10 years' time, is going to be radically different. And so those convergence trades are the ones to jump on, because if you can spot them, they can't go wrong.
So are we getting an inside scoop from you that you think Ethereum's going to overtake it, or what?
No, I'm just saying that recently it's sort of burst out of its burrow, if you like, and that Tom Lee being part of something in it and whatever, there's been a lot more focus on it. Certainly the Trump administration has made things considerably easier for decentralized finance, and is the start of the journey towards one decentralized financial world.
My last question for you that I ask all my guests is, what is the last investment you made? What's the last thing you did? Like yesterday, maybe it was this morning, I don't know.
Well, just really buying Bitcoin again. Went long silver last week and gold, and they had a really good pop-up yesterday. So I've taken some money off the table. Long in superannuation fund as well. I've been good, to slightly not answer your question, in stagging Tesla, in that if you look at the charts, when it breaks out of the charts, it's got this habit of reappearing in the charts pretty quickly, because the market wants to hate it. Its proponents love to adore it. You know, it's nothing different from what other people say, but it's not a car company. It's something else, whatever it turns out to be. And Elon Musk is super good at reinventing what that's going to be. He's like David Bowie, that every time something sort of stalls out a bit, we better get a haircut and some new clothes.
I've never heard that. That's good. Yeah, comparing.
Don't tell Elon that, or he'll be appearing like Ziggy Stardust or something.
Yeah, that's good. So you're like, volatility is your friend. Is that how you make your money?
Yeah, so if you want me to talk about the difference of trading and market making, which is my experience, I can do that. So the principles of trading as a small retail trader, so not working at a prop desk or with other people's money. So I'll keep it to like 10 points, and this is what I help people with. So, first thing is, what is it you're interested in, and how do you set your entry level? Who knows why you would get interested in? I presume that it's volatile or is not volatile. So when you see things not moving, there's a good reason for that. I.e., they've reached the bottom and they're getting crushed down, i.e. they can't go down too much more. You might say in stocks that's because they've got stocks got good cash flow or PE ratio, whatever, and then just we've got a bad overall market. Stocks are moving around a lot. Well, sometimes you've got to catch a falling knife, but there are techniques to help you not lose all your fingers on the first trade. Secondly, don't worry if the price doesn't get to where you want to buy it or sell it. There's a million trades every day. Everyone says this. But actually doing it is the key thing, right? I've sat through months of not trading. It kills you, only to take a trade and you lose money. But you learn from this, and it's all about learning and discipline. If you've got a position on, set your stop loss. And if you're worrying about your profit and loss from that stop loss, you've got too big a position. This is the number one killer of trades, because as soon as you put it on, you're starting to worry about it if it goes against you. At banks, we have the unfortunate thing of having to mark to market at the end of the day. And so and this is something that happens to retail traders as well. So as you walk off the floor at the end of the day and it looks like you're winning, the trading manager walks in, come on, let's go and drink beers. Let's get all the lads and have a good day. And you walk in the next morning and it's gone down again. But you haven't lost any money. And now it's the worst day ever. I mean, you completely lose track of reality if you're trading against a predetermined time where you've got to market. So you need to get out of that mindset that you've made money when you haven't traded out of it. Try and pick a trend as a retail investor, because if your trend is right, the trend is your friend and you will get out of a bad position. The market will get you out of it. Believe in the trend. Where trends change, this is what you need to spot. So no matter how high or low, depending on your view, is spotting where the trend changes is the key to retaining profits. If the market's bullish, it's going up, you're getting higher lows and higher highs, but suddenly you're not. It's very easy to convince yourself it's a market aberration, because the market's very good at aberrating, if that's the right expression. But the chart and the price is the truth. If it's not doing what you're expecting, you need to get out or have a plan to get out. And that's really key for retail traders, in that the expectation of how much you can make is always way too much, but you do want to and are told to run your profits, right? So that's difficult. Run my profits, well, it's going to infinity then, obviously. But, more key to what exact level that is, and when you start scaling out, is to realize when the trend changes, because you will be losing all your equity really quickly. Yes, you can spot that. Listen to social media and do the opposite. That sounds a very glib statement, but what people put on Twitter, which is obviously the preferred medium for financial markets, is almost always people talking their own book. It's like at banks, when the big banks do a deep dive analysis of a very popular share, whatever, Amazon or whoever it is. Pretty much they've always got a big position in this, and they're going to talk their book. And it's great to keep those retail traders in the market, to keep pushing it up without the institutions having to do anything about it. Quite a lot of the commentators that you see on YouTube, for example, are full of this, it's the institutions trying to get you out of your trade and whatever. The institutions are just sitting there going, hey, let's just let the retail traders push this up. We're doing our own thing. We are market making this. We don't care, but we're happy to sit on a position that we might have underwritten because we have to. Some block trades we have to transact. So there's lots and lots going on, rather than a whole team of institutional traders at an investment bank thinking about retail traders. They don't care, but they'll allow markets to go with the flow if it suits them. So use social media and all of that noise to tell you a point where it can't possibly go there because everyone's too optimistic. And that's the point to start scaling out. Scale in and scale out. Don't put on your...
How do you feel about today? If you look today, everybody's bullish, and it's AI, and new highs. Do you think that's a contrarian indicator to say, okay, we're nearing the top, or what?
I think it's going up still, and it's going up for a different reason than everyone thinks. For the last 5 years, everyone has, all the talking heads, right, have been saying, INIP ratio's too high, can't keep on going, right. Housing market's going down, there's all these delinquencies, blah, 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 and it still goes up, right? And it's going up because of money printing. And if you look at the chart of the S&P over the last 50 years against the balance sheet of the Fed, it's a horizontal line, because the more money they create that goes to investors because they've got assets, the more they have to put it in those assets, which keeps the price going up. And it's just this cycle until something systemic happens. I don't know what that will be. So trying to pick a top by headlines gets you, 3 months of fame, but you're only as good as your last trade. So it's much better, I think, if you're a retail trader, to just say, look, I kind of like the markets, it keeps going up. I'm just going to bring my stop up every day. Just slowly but surely take some money off. And, you don't have to have a position all the time, but you'd like to have at least 50% of a good trend. And we've had a really good trend. And if most retail traders haven't had 50% of the last 16 years, then, they've left a lot of money on the table.
And now, is that one of the reasons why you're in Bitcoin and gold and silver, just because of all the money printing? Is that kind of part of that trade?
It's also, money printing is part of the decline and fall of the traditional fiat system. And its lifeline is now crypto. And we've seen this since Trump got in, and Scott Bessent is going, oh yeah, stable coins, great. They can buy $7 trillion worth of US treasuries with it. It's like, we spend lots of time as inventors of financial products trying to fight the authorities, and now they want to adopt it for their own purposes. Well, Scott Bessent clearly wants to support the treasury market with that, and I don't blame him for doing that. It sounds unlikely, though. It sounds like a much better way to transition to a better way of, more transparent way of doing things, where you don't have so many systems in place to manage this sprawling debt-based economy that is now structurally out of control. Meaning that, do we ever need a central bank? Well, we won't answer that question. Do we need a central bank to have 15 different programs to support banks, market makers, primary dealers, fund managers? Do we need that? It's just the end of a very long cycle that started in 1971 when Nixon took us off the gold standard. Did you want me to talk about market making now as just a bit of a reference?
Sure, yeah.
So as a market maker, you're a wholesale buyer and seller of, in my case, currencies. So we would never do a deal less than $5 million. Every week or so, maybe 2 weeks, $1 billion deal comes up. And you are literally trading every second of the day. And there's 5 of you quoting the same thing. And you are the one that has an overall position idea, and that we like the market at the moment for the next 20 basis points, and then we don't. Because we've got sell orders or stop losses and all this sort of stuff. So we're turning over huge amounts of money for very small amounts. So we make our money on our spread. I buy it at 115.25, sell it at 115.30, but I do it in $100 million, so I make a lot of money.
And you just got to avoid getting caught holding a big position and the market moving against you. Is that kind of the idea?
By definition, you are going to get caught every time it moves.
Yeah.
Because typically, let's say Canadian dollar at Bank of Nova Scotia. Let's keep it Canadian. In my time zone in London, I've got 4 other market makers that will quote me. But I've got every other bank in the world that I have to quote, notwithstanding all of the corporates like Ford Motor Credit and people that do serious amounts and are dealing with all of the other banks as well. So in a big move, you're going to get killed. The trick is not to get killed as much as the rest of them. and to make sure that there's enough liquidity left. And typically we always know who's had a bad day, and we'd always give them the opportunity to make some money at the end of the day. As I would sell them some cheap dollars because I've got to do it anyway. I'm not going to wait for the next hour. You can have someone and watch it go up, because we need that person for the liquidity purposes. Otherwise, no one has a market to trade. So it's a really big thing and a really challenging thing. And so you always have to have a view, but that view will change many times a day. That's really tricky, right? So it's going to go up, and then suddenly it's going to go down, and suddenly it's going to go sideways, then suddenly it's going to go up many, many times. And it's what other people are doing to you that makes you change your view on the direction, simply because of the money flow. A bit like a bookmaker, if you like. Always have as big a position as you can to quote against. So the antithesis of being a retail trader. Have the biggest position possible if you think a big move is about to happen. So as someone comes and sells $1 billion into the market, in the London markets, in market, only 4 other people quoting each other in $5 million a piece, you've got to be really short in front of that event. So it's a really challenging thing to do, because as soon as you have to sell some dollars, you call the other Canadian banks, who call the other Canadian banks, who call you. So it's pass the parcel a few bits until you hit the buy orders or the sell orders that you have on either side. And then if it takes those out, you've got to run your own customers' stop losses. So as a bank, if you execute a stop loss for a big customer, you don't want it going down to 115.04 where their stop loss is, and then going up 115.60, because you'll lose the next bond deal they're going to give you, which makes you $10 million in commission. So it's really, so if you're going to run the stop losses, do it properly. Don't use it as your own exit liquidity. Make sure it's going down as those losses are hit to the downside. Always quote the brokers, because they are your access to other people's markets. So when a bank in, Saudi Arabia comes and asks an interbank broker for a price in $500 million against Canada, you want to be the one that quotes it. And if you're lucky, you're quite a really good price, so they really respect you as a bank, but you don't get the deal, someone else gets it. And you can make some money on it getting down, because the moment that happens, it'll delta away and everyone will be calling you. So you have to be really quick, and it gets really tiring really quickly.
Now, does that still operate in the same way today?
Yes.
Like, yeah. Because and there's still the bond market is still kind of similar, and they're trying to do some disruption in that area, right? Like having more automated quotations so you can look stuff up, but it's still a phone call, right?
Pretty much, yeah. So you got your primary dealers in the US who have exorbitant privilege and complain unerringly about it, but there's lots of liquidity there. There's lots of liquidity because there's so much debt, and there's lots of things that you can do with that. In the dollar Canada is one thing, whereas 10-year bonds are many things. So there's your on-the-run bonds, which everybody measures the price and therefore the yield by, and there's your off-your-run. So if I really have to dump a load of on-the-run bonds, I've always got a way of getting rid of or acquiring off-the-run bonds that other investors have to be flexible with price on because it's illiquid. So pretty much this is what the Fed's been doing recently. Sorry, the Treasury has been doing recently, which is buying back some of their off-the-run treasuries to increase market liquidity, because as bonds go down in price, no one wants to own those off-the-run things where it might be an X 30-year bond is now 7 years, but with a weird date and different coupons and calculations and stuff like that. They want the visible market one. So by buying those back, they've increased the liquidity into on-the-run securities. So it's a little bit easier in the Treasury market, and lots more counterparties, of course, because almost every bank in the world has owned some, and so does many other organisations, whereas the Canadian dollar is outside of Toronto hours, only for those that have an interest in it.
Before we go, let's talk a little bit about Suberia Capital. You have a daily newsletter that you put out, Limit Up. I love the name.
Yep.
And
there's a bigger one at the weekend which deals more with countries and economies. We're just about to expand what we do, as it's currently sort of more about me. I started those newsletters as my own notes, if you like, so I can keep a track of the way things have been progressing. Built up a little bit of an audience. Happy to help people out. I think there's going to be big changes in financial markets the next 5 years. My job is to help people try and understand how it all works.
And they can find you on LinkedIn. They can find you on Twitter. X, I guess. They can find you. All right. Any other things you want to let people know before we go?
No, that's about it. Thanks very much for inviting me on.
Oh, thanks for coming on. We've been talking with Ian Reynolds of Suberia Capital. Thanks a lot, Ian.
No worries.
I mentioned in the intro my $1,000 investment in AGF Growth Fund. That at the time was my biggest single investment. $1,000 was a lot of money to me at the time, being fresh out of high school. I watched over the ensuing months and years as the fund got hammered in the wake of the dot-com implosion. And all the while, the fund managers were collecting their 2.5% to 3% management expense ratio. I eventually sold my shares in July of 2006, so I had held on for just over 7 years. And how much did I get for my $1,000 investment? Well, I got back $587.32. While this was a major disappointment for me at the time, in retrospect, it was also a great lesson because I never again invested in a mutual fund, and certainly never in anything with an expense ratio that high. I probably hung on to it for too long, and while it did eventually recover, it didn't get back to the point where I bought it for another 10 years after I sold. So if I had held on, I would still be waiting 10 more years to recover my initial investment. The lesson I took from this whole AGF debacle was that I didn't want to let somebody else be in charge of my financial destiny. I didn't want somebody else making decisions on my behalf. And I certainly didn't want to pay them 2.5% to 3% to cost me money. I decided I didn't want somebody else to be responsible for my financial success. I certainly didn't want to put someone else in charge if it was going to result in something less than stellar returns. Please remember that this is for entertainment purposes only. This is not purported to be investment advice. Please do your own research and do your own due diligence. We hope that maybe you've learned something from this podcast and been entertained. If you'd like to be a guest on Terry Hogan Talk Stocks, you can find me at Terry M. Hogan on X. If you liked this episode, please tell somebody else about it. Give us a rating. And if you're interested in all things currencies or trading, please check out our guest, Ian Reynolds, at Suberia Capital. That's Suberia, Suberia Capital. Thanks for listening.